Hello class, this is Dr. Fenton. We have another homework problem from Module 5, and this is the cash budget, a fairly large cash budget. Let's take a closer look. Let me scroll down a little bit. Okay. They tell us that they have budgeted the following cash flows. So they expect each month to have cash in January, let's say at 120, February 126, and March 146. So that's what they expect to collect in cash each month, probably from sales or something. Cash payments, they've already worked through these numbers, and they said that in January, we expect to pay cash for inventory purchase of $100,000, and for selling administrative expenses, probably $41,000 in cash. These are all cash payments. These are expected cash receipts in each month. These are expected cash payments in each month. Now let's read some more information. And what we're going to do is prepare a cash budget. Now here it is. We're going to go through these numbers in a second. Here it is. It's quite large. So this is what we're after. But let's see what else they say. The medical center had a balance of $18,000. This is a cash balance on January 1st. The company desires to maintain a cash cushion of $7,000. So what this means, they do not want to go below $7,000 in their cash balance at the end of any month. So let's keep that in mind. If they have to borrow money, they have to borrow money in $1,000 increments. So if we see we're going to fall short of $7,000 as a cash balance at the end of any month, we have to go to the bank and borrow money. Okay? When we borrow money, we have to borrow it in $1,000 increments. No more nor less, 1,000 increments, either 1,000, 2,000, or whatever. But when we repay the cash, if we have excess cash, we can make payments on the loan. We can pay in any amount available. So we have to borrow in $1,000 increments. Interest rate's 3% per month, which is a very high interest rate. And then if they repay the loan, they can pay in any amount, not just in $1,000 increments. So lots going on here, so pay attention to that. They pay vendors last day of the month, and the company had a $40,000 beginning balance in its line of credit liability. What this means is going into January, they already have borrowed $40,000 to keep their cash balance high enough. So we're going to see if in here someplace we can start paying that down. We might see, do we have to even borrow more money for a short time? So we're starting January with $40,000 in debt already. Here are the expected cash receipts, cash payments, beginning cash balance. So let's start putting this together. Beginning cash in January, $18,000. Drop it in. Add cash receipts. They've already done this for us. $120. Drop it in. So now they say total cash available during January, $138,000. Okay. So we start the month off with $18,000. We expect to collect in cash $120,000. So we expect to have cash available $138,000. Now let's look at the cash payments. For inventory purchases and the S&A expenses, they've done that for us. Drop these numbers down, $141,000. And then we have interest that we paid in January. So where'd the $1,200 come from? Let's go back up here. At the beginning of January, we had $40,000 in liability already. Already a bank loan of $40,000. Interest rate 3% per month. So let's take 3% times $40,000. That means we have to pay interest of $1,200. So we pay interest every month. So again, the $1,200 is the liability of $40,000 at the beginning of January times 3%. 3% for 1 month, $1,200. Total cash payments are expected to be $142,200. So look at this. We expect to have $138,000 cash this month from where we began, what we expect to collect. But we expect to pay out $142,200. Well, subtract $142,200 from $138,000. If we don't do anything, we are going to run out of money. In fact, we're going to be $4,200 in the hole. I mean, we're just going to be short $4,200. Remember, they said that they want to have a balance of 7,000. Well, we need to go from a negative 42 expected to at least 7,000. So we have to go out in January at the end of the month and borrow some more money. How much do we have to borrow? We have to borrow enough to get from a negative 42, and this is tricky in here, be careful. We have to go from a negative expected $4,200 up to at least 7,000. Again, we have to go from a negative 4,200 to at least a positive $7,000. So if we add, just to get this started, if we add 7,000 where we want to be to the negative 4,200 that we think we're going to have, take the minus signs away. We have to go from a negative 42 to at least $7,000. Add 7 to that, that's $11,200. So we have to borrow at least $11,200 to get to a cash balance at the end of 7,000. Well, they told us up here though, if we borrow money, we have to borrow in $1,000 increments. So we cannot borrow $11,200 to get to an even 7,000 here. We have to borrow $11,200 but go up to the next round number in the thousands to 12,000. So if we need, somewhere over $11,000 to borrow, we have to go to 12. We have to borrow $12,000. That's why it says it's a little bit tricky in here. So if we borrow $12,000, that's going to offset the $4,200. That will leave us with a $7,800 ending cash balance. Again, they're not saying that we have to be exactly $7,000 here. They want to have at least 7,000 as the balance right here. We can only borrow in increments of $1,000. So we have to borrow 12,000. We cannot borrow 11,200. So if we borrow 12,000, ending cash is now 7,800. This borrowing does not change this interest. We borrow this at the end of the month. We're going to pay more interest next month. You already see that. Okay. All right, let's go to February. Now, February's beginning balance is January's expected ending balance. Take this 78, drop it in here. That's where it comes from. Now you can go back up and pick up expected February collections, 126. That gets us to expected cash available during February, 133.8. Let's take these payments going out the door in February, 82.42, drop those in. Let's calculate the interest for this month. So we were at $40,000 at the beginning, the liability, beginning of January. We borrowed $12,000 at the end of January. We're now up to $52,000 at the beginning of February in debt. Let's take $52,000 times 3%. That's $1,560. So the interest payment in cash for February is the beginning debt we have at the beginning of February, $52,000 times 3%. And again, $52,000 comes from this 40, our debt at the beginning, plus what we had to borrow. 52,000, 52 times 3%, 1,560. Add the payments up. We expect $125,560 to go out the door. That's a lot less than cash available, so at least we're doing okay this month. In fact, we have an excess of cash, $8,240. Of what we have here coming in, what we expect to come out, excess a positive $8,240. That means we can take $1,240 and pay off some of the debt. That drops us to $7,000. You might think, well, wait a minute, I thought we had to use $1,000 increments here. Only when you borrow. When you borrow in $1,000 increments. When you pay it off, you can pay off in any amount. So if we have $8,240 expected at the end of February as a surplus, we can pay off $1,240 on the debt, and that gets us to our minimum $7,000. March, this $7,000 drops up here. Bring March's expected collections, $153. March expected cash payments, $95.37. The interest we're going to have here, I think they show us how to compute that. Yes, here's the calculation down here for the interest that we have. This goes back to the beginning of January's liability, $40,000. The amount we borrowed at the end of January, $12. There's the $52. Got to February, we paid back $1,240. Take that out. So this is the amount that we have at the beginning of March. Net this out times 3%. So $1,523 is the expected cash payment for interest in March. Add these up. Expected cash payments total in March, $133,523. A lot less than the cash available. Well, it looks like we have a surplus of $19,477, and we have enough then to pay off $12,477 in the liability and then that drops us to a minimum of $7,000. Okay, so this is a very detailed statement. It's not too bad at the beginning here because this is given to us, this is given to us, we just add. This number's given, this number's given. We do calculate this one based on our liability in the borrowings as of the end of the month. Add this up, total payments, and then you see if you have a expected shortage or expected surplus. Expected shortage, you have to borrow enough money in $1,000 increments to have at least $7,000. If you have a surplus, you can pay off in any amount, so pay off enough to drop it to $7,000. All right, so that's a quick review of this problem, so good luck with your studies.